This is alarming. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, China just initiated crisis protocols. I'm going to show you what China did and why, but more importantly, we're going to answer the question, is the rest of the world in danger? The alarming truth will be revealed, and is the U.S. economy headed on the same path as China? Stay tuned. Now, before we head over to Bloomberg, I want to thank all of you for your well wishes. We made it through the storm. We're back in the studio, and I want you to know I appreciate each and every one of you. Now, let's over to Bloomberg, where we picked today's story up with a headline as the PBOC starts a $71 billion liquidity tool for stock investors. And this is something that you do not see when economic times are good, when the economy is booming, when consumers are out spending. This is a risky move by the PBOC because what they're trying to do is boost their stock market here, and I'm about to show you why it's going to lead to a massive unwind of the market and send the economy plunging even deeper than it is now. The People's Bank of China will accept applications from eligible securities firms, funds, and insurers starting on Thursday to obtain highly liquid assets such as government bonds and central bank bills if they provide certain collateral. So what these institutions are going to do is go to the PBOC, get collateral, and then use the money to buy stocks. And what you're seeing here is Beijing wanting to drive the equity markets up. But this is a huge risk because anytime you apply leverage, or in this case, using borrowed money to drive equity prices up, if it doesn't stick, well, the unwind is even deeper than it would be. The size of the tool is 500 billion yuan. It can be expanded in the future, the monetary authority said. The funds obtained through the facility can only go toward investment in the stock market. Bonds, stock ETFs, CSI 300 constituent shares, and other assets could be used as collateral. This according to the PBOC, who wants people to buy stocks. They want to send the market higher, and this is really dangerous for the global economy. And in particular, when we look at the U.S. equity market, it seemingly continues to rally despite what the actual data is telling us. You see a massive amount of risk here building the markets at a time when people really don't perceive there to be risk in the markets, and that's dangerous because when bubbles burst, well, we know it gets really bad for the economy. Because when we look at China, and this is the same issue we face in the U.S. and all around the world, is consumer spending remains sluggish and is under strain from a weak labor market. And it makes perfect sense. When people don't have jobs, they tend to not go spend money. But yet look at Beijing's response here. And I want you to understand why this is just a crisis move that's not going to work, because all they're doing is applying leverage under the equity markets, when in the real fact here, what the real issue is, consumers just don't have the money they used to have, and they don't have confidence in the labor market. And here you can see when we look at the U.S. data, if we take real retail sales, this is inflation adjusted, shown in blue on a year-over-year rate of change, and we overlay the NASDAQ 100 in red, what you can see is there's times like we headed in the dot-com bubble where investors were just mega bullish on tech stocks. It drove the market higher, but look at what happened to real retail sales. They continued to slow down and then eventually contract. Now, what Beijing's hoping for is a bit of wealth effect going on here, something that Alan Greenspan coined, that if people feel more wealthy, they'll go out and spend. But the data suggests that that's not true at all. In fact, we can go look at the global financial crisis. What do we see here? A gradual slowdown in real retail sales that eventually contract. You see the market rallying here until the crisis catches up and sends stocks heading down. And how about now? The same thing is happening once again. Real retail sales remain negative over the last 2 years. And look at what investors are saying, that companies are going to continue to make record profits, record earnings, and that's going to drive the market higher. Yet history shows here that if you try to juice the equity markets, it doesn't translate into consumer spending. So you see this risk now building under the Chinese equity markets. What this is going to do is eventually create a bubble. It's going to burst. It's going to panic. Of course, markets all around the world, because China's got a big problem. It's called deflation. And based on the latest data, and this is a reaction that you're getting out of Beijing, it's not getting any better. And China wages in 2 quarters of gains, adding to deflationary risk. Here you can see salaries offered to new hires decreased 0.6% from a year ago. And this is the same risk that we're seeing all throughout the world, throughout global economies. And it's coming for the U.S. economy. And what this says is, for the equity markets, it's not good news, and that policymakers are completely clueless this, and they're going to send us into an even deeper recession, cause massive amounts of wealth destruction. And here you can see Chinese companies lower their hiring wages. You can see starting right around sometime in early 2023, you see that contraction in wage growth. And these figures add to other recent data in revealing a worsening job market that's discouraging residents from spending more and deepening a cycle of price and wage declines. Now, what are we hearing in Europe? Well, we're hearing about the automobile market, how manufacturers are struggling and starting to lay off. We're hearing about their manufacturing sector. How about what's going on here in the U.S.? The survey data, despite that red hot non-farm payroll report, what are they telling us is that things are slowing down, that we're seeing companies start to lay off and cut hours, and what that's going to put is downward pressure on wages and in a big way. But something that shouldn't be deflating, that's your trading account. Check this out. Despite markets going all over the place, what we see is our uranium trade is staying up for another move higher. It pulled back a little bit. Right now it's up 13.7% as of yesterday's close and looking to take off. And here's the deal. You could have made this trade, and even better, you could have done it for free because this trade hasn't even been on the books 30 days. And we offer a 30-day free trial. How do we do this? Well, we have our CTA Timer Pro. We do a mimic of machine positioning. When they get into a deep short position and price moves against them, it triggers a signal on a report to buy. We run a historical overlay that gives us the edge, and even better, we back tested all the data. We actually know our signals are amazing and make money for you. How about Momentum Timer Pro? We got a back test coming on this very soon, but we look at all those technical indicators, add a proprietary overlay, and look at momentum over longer periods. How about this? 3 open trades, 100% win rate, 1 new trade added today. That's what you call batting 1,000. How can you make money trading? You get our daily reports, you get the signals, you get my opinion. I tell you the trades I think are the best. You get back tested data that validates reports, stop loss levels, full tracking trades in return, a weekly update, a 30-day free trial, a fully duplicatable system. All you got to do is place the trades. Links in the description below. Start making money trading, because if what's happening in China is coming to America, well, people are going to be looking to make money, and you can make money in an up market or a down market, because the employment subgauge of China's non-manufacturing purchasing managers index in September fell deeper into contraction territory to reach the lowest level since December 2022, when the country was hit by an exit wave of COVID infections following the pandemic controls. And the official jobless rate climbed to a 6-month high in August, while youth unemployment rose to a record high this year. And so we talk about what's going on in China and Beijing here, trying to juice the equity market, thinking that somehow someone who's unemployed is going to say, wow, the stock market's going up, I should go spend money. But they don't have any money. That's the issue. It's the same thing we see here with the U.S. equity markets. People don't have the money, and yet at some point we're going to see a reversal, and it's going to send the economy plunging in a big way. And the evidence is clear about this. When you look at average hourly earnings, this of production and non-supervisory employees shown in red on a year-over-year rate of change, against the unemployment rate, you see these deceleration in wages. In China, you're seeing an outright contraction for new hires, and it makes perfect sense, because as more people lose their job and stay on unemployment, which is evident by a rising unemployment rate, well, what happens is employers do not have the need to give their employees big raises, and you see downward pressure on average hourly earnings. And you can see a near mirror relationship between the two, and in particular, going to each and every recession, it's marked by a rising unemployment rate and a slowing of average hourly earnings. You see that happening now. The only difference is in the U.S. it still remains a rather red hot average hourly earnings growth rate, but what we know is the unemployment rate is rising, which suggests that perhaps the U.S. is on the same course as China. This is dangerous. We'll answer the question, of course, later. Is the rest of the world at risk? Are we at risk? Because last year, new hire salaries recorded their longest streak of declines since the data on yearly changes became first available back in 2016. And underscoring the sluggish consumption picture, tourist spending during a week-long public holiday at the beginning of October came in below pre-pandemic levels. So what you see is evidence across the board that the labor market is slowing because the global economy is slowing. And as people figure this out, have less money to spend, start worrying about their jobs, what do? They spend less money, which leads to people losing their job or getting their hours cut. It's just backfeeding into a downward spiral. But again, Beijing said, hey, if we prop the market up, or in the case of the U.S., if more people keep driving equity prices up, it'll translate to spending, but it never does. What really matters is the consumer, and we don't see them in very strong shape. In fact, when we look at the NASDAQ 100 now shown in blue against average hourly earnings of production and non-supervisory employees, there is something interesting, is you tend to see further declines or declines in the equity market marked by a slowdown in average hourly earnings growth, because if people don't have the money to buy stocks, well, that means prices are coming down. But look at this. Here you see a very obvious slowdown in average hourly earnings against a rallying equity market. It only makes you wonder which one is right. Are earnings going to head up or market's going to head down? Weigh in the comments below. I'd love to get your opinion on where you think the markets are going. But now let's focus on the rest of the world. Are they in danger? Is the U.S. economy in danger? Let's take a look at today's data, because we got the consumer price index and it rose more than forecast, stalling inflation progress. Of course, many people believe that inflation moves in a straight line, but it doesn't. It goes up and down, but it's the trend that matters, and the trend is indeed lower, because when we look at total incomes, which is a form of average hourly earnings multiplied by average weekly hours of production and non-supervisory employees in red against the consumer price index in blue, what do you see? When you put them on a year-over-year rate change, it's very obvious where incomes go, prices head. And here we can see this continued deceleration in total incomes, because workers are not getting more hours. They're actually seeing their hours stagnate. And we know as demand continues to go, their hours worked will get further cut. They'll have less money to spend in the economy. Demand will go down and price growth will go with it. It's a gradual process, but the trend is very clear. What we see here is a blue line continuing to head lower. That's the consumer price index. We know wages are falling in a big way. The so-called core consumer price index, which excludes food and energy costs, increased 0.3% for a second month, disrupting a string of lower readings. The 3-month annualized rate advanced 3.1%, the most since May. And yet economists see the core gauge as a better indicator of underlying inflation than the overall CPI, because for some reason consumers do not eat or consume energy, which is baffling that they think this is a better gauge, because we all consume energy. We all have to eat, and those prices do make a big difference, because when food prices go up, which they are now, and energy prices go up, which they just did, well, it means we have less money to spend on other parts of the economy, and that affects everyone. So yes, I disagree with them completely. I think the core gauge is not a better gauge. I think the headline is the way to go. The measure rose 0.2% from the prior month, boosted by housing and food. Of course, again, these things that people don't spend money on, but yes, they do, which accounted for over 75% of the advance. Good prices rose as well after reliably falling over the past year. But again, when you see the CPI go up and wages continue to head down, what it means is that consumers have less money to spend on the discretionary side of the economy, which is why when you see increases in housing, food, and energy, it's not good for everyone else. But yet the experts say the core gauge is what matters. Here you can see the core CPI in red, this excluding food and energy against the headline number in blue, both on the year-over-year rate change. And what can you see? Well, the headline number is rather jagged. It oscillates around, but where it goes, the core gauge tends to follow. Right now, what we see is a headline CPI heading down, telling us that the core gauge will come down at some point. The higher than expected inflation figures, along with last week's blowout U.S. jobs report, will likely amplify the debate of whether the Federal Reserve will offer a smaller interest rate cut next month or pause after a large September reduction. Officials penciled in another half-point cut by year-end, meaning one in November, one in December. And many said they're watching developments in the labor market, as they should, because there is something very interesting. Every time you bring inflation down from very high numbers, what do you lose? You lose a labor market. You lose a labor market. Inflation is not your problem. It's a recession. You know what doesn't fix that? Well, that means rate cuts don't work. Here you can see the evidence. When you bring inflation down from high levels, here we go back to 1990, you see inflation rally up somewhere right around 6%, came crumbling down, and what did you lose? Well, you lost the labor market. How about going to the dot-com bubble? Inflation got up, and then they brought it down. What happened? Labor market went. Same thing again going to the global financial crisis. How about now? Well, they say this time is different. Well, it's always different until it's not. This time they brought inflation down. There wasn't a big impact on the labor market, but what we're seeing is demand decline. And when demand goes down, more people will hit the unemployment line. And we have evidence of that as policymakers pay close attention to wage growth, as it can help inform expectations for consumer spending, the main engine of the economy. A separate report Thursday combined inflation figures with recent wage data showed that real or inflation-adjusted earnings grew 1.5% from a year ago, which is the most since June of 2023, telling us that we've already known this, that consumers are falling behind. But the data says, wait a minute, due to inflation's up 1.5%. But the CPI doesn't cover everything. It doesn't include, say, rising insurance costs. It doesn't include debt service costs. It doesn't include everything that impacts consumer spending. We know the households are falling behind. The government just hasn't figured it out yet. And even other data shows Social Security benefits will increase to 2.5% in 2025, the smallest boost since 2021. But here's the evidence that we're headed in the same path as China, as they're losing their labor market and focusing on the stock market to fix it. Here you can see U.S. jobless claims now soared to a year high, hit by Helene and auto cuts. And of course, anything weather related is going to be dismissed. But here's the deal. I just went through a hurricane. There's a lot of people that are going to lose their job because the businesses they worked at were destroyed. They're not there anymore. Or maybe their house is gone and they've got to move and they're out of work. They can't bring money into their household. What happens? They go on unemployment. Their spending immediately decreases, and that affects everybody. So even though, of course, storms are transitory in their nature, they came and go, but their effect on the economy could be huge. And remember, we're at an inflection point. Anything can tip the U.S. economy into recession now, including people being on unemployment due to weather. Initial filings rose by 33,000 to 258,000 in the week ending October 5th. On an unadjusted basis, more than half of the advance was tied to states affected by Helene, including North Carolina and Florida. Michigan, meanwhile, home to a number of auto assembly plants. These are real jobs really being lost at all states, with nearly 9,500 increase in applications, telling us that the manufacturing sector of the U.S. economy is following what happened with China and what's happening in Europe. It's happening here. You lose those jobs, they're not coming back. That's the issue, and neither is their spending power. It's a dangerous direction we're headed here, as continuing claims, a proxy for the number of people receiving benefits, rose to 1.86 million in the previous week, and that is not good at all. It's telling us people on unemployment can't find jobs. So as we look to figure out where the real data here, when we look at continued claims and the unemployment rate, the trend is your friend, and trend is to the upward direction. That's the risk here. And so we turn back to the beginning of the show where we ask the question, is this dangerous for the rest of the world? Is the U.S. economy following the same path as China? And the answer is yes. The only difference is the U.S. isn't focused on juicing the equity market, even though, of course, investors believe rate cuts are really bullish for stocks. They're not bullish when you have 9,500 people lose their jobs, and you have even more people lose their jobs due to storms. It's not bullish for the economy because those people have just lost their spending power at a time when saving rates are super low. The risk here is what's happening in China with deflationary forces affected by a weak economy, and their labor market is coming to the rest of the world. It's coming to America, and all signs right now point that we're all headed to a globally synchronized recession. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.